Hey everyone, it's John from Rain King LLC. It's time for a general market update. It's July 21st, 2023. I'm recording this about 12:30 p.m. on Friday. Currently, the S&P and Nasdaq are at the lows of the session, while the Dow is outperforming, and we've talked about the Dow catching up and broadening of the rally. So before we launch in, just a reminder that I'm an amateur individual growth stock investor, not affiliated with MarketSmith or IBD. Here's the agenda. We're going to talk a little briefly about the Nasdaq. Then we're going to get into market breadth. And I want to spend the most of our time on portfolio management this week. And then we'll do a wrap up. So here's the Nasdaq on a daily chart. I cut this about an hour ago. So a couple things I wanted to point out. First of all, just the context. In 2023, the Nasdaq is up almost 41% plus since the December lows. That's a really, really great move. We're actually approaching the April 22 highs, which are at 14,646 and change. So it's kind of natural point where maybe we get a little bit of a slowdown in the move. The shaded areas on my chart in red are actually the 920 EMA gap extension warning that I used. I covered that, I believe, in the June 6th video. And when you combine that with being extended over the 50-day, that gives us a caution warning. You can see we had 4 or 5 days in a row where that was kind of flashing. We were actually 8.5% above the 50-day. So yesterday's action was not necessarily surprising, with tech getting hit the hardest. In terms of a pullback in the NASDAQ, we've already come off 3%. If we came back down to the red line, which is the 50-day moving average, that'd be about an 8% pullback, which would mean we have another 5% to go. This blue stepped line is actually the 10-week moving average, which is always close to the 50-day, but it's actually slightly higher. So that's just something to be aware of. So the NASDAQ is pulling in, not unexpected at this time. Now let's look at the market breadth. Couple things. Again, this is from Carson Research, who got it from data from Ned Davis Research, but it's talking about the breadth thrust from January that I've mentioned multiple times. The key thing is we talked about the progress we were making at the milestones and how we were actually behind the averages at the 3-month marker and the 6-month marker. You can see here in yellow, we were at 13.3. The average was 15.8. The 1 year, 12-month, typically from a breadth thrust like this we experience would be about a 20% gain. We could still get there. But like I said, we know that we're kind of accelerating the last few weeks. So there is some catch up going on. And I've been tweeting on the last couple of weeks that we've been getting some very strong breadth, evidence behind the rally. So that's all positive, and we'll just keep monitoring it going forward. This is a chart, a WISE chart, and you can see the credits on the bottom of the chart, just tracing the S&P in blue and the National Association of Active Investment Managers, their exposure index, which is shown in red. It's just showing the correlation that active managers are putting more money to work, and it's coinciding with the S&P moving higher. It is getting a little heated for the active managers, up around 93%. Typically, you get above 80. We want to be aware of that, but certainly money's being put to work. Now, this is the New York Advanced Decline line. This is looking at the S&P in the upper panel. The point I wanted to make here is if you look at the AD line, we are actually pushing towards a 15-month high. And you can see that goes all the way back to March of 2022. So that's great that we're hitting new highs in the advanced decline line. And the correlation is looking at the S&P. The S&P has not quite broken out to new highs from the 15-month mark, which was back in March of 2022. So seeing the breadth leading the way here, I think, is a very positive sign. We'll keep monitoring this going forward. 2 other breadth measures. On the right is the net new high, new low on the NYSE. Now, even with yesterday's tech sell-off, The net new highs on the S&P, the New York Stock Exchange, remained positive. We still had 91 net new highs. So that's very, very positive. Yeah, on a bad day yesterday, that was very specific to tech stocks. Now, I've also shown the S&P index, the percentages of stocks above the 50-day moving average. And you can see that the 50-day percentage up to 87%. The previous high that we had was back here in December of 2022, and we are ready to challenge that now. So that's also, it's been improving and improving and improving. Another sign about the breadth still looks pretty good in the market. Now, I want to get into portfolio management. We've had rare times to talk about portfolio management when you're in a bear market and you're never really able to get much traction. Hopefully, you've been participating in the last 2 months and do have some traction. So we're going to talk about how do you manage your portfolio at this stage in the rally. So last week, I highlighted about ranking your stocks from best to worst. You wanted to know which stocks you might sell at 20% gains, which ones are you going to try and play out for bigger gains. We talked about cushion, and we talked about, are you willing to give back some gains if you have the desire to try and play something out that you believe might be a model book stock. So we've been talking about the pullback the last couple of weeks. It certainly seems to have started. So we want to be prepared with a game plan. So important. So the first step is to know the leading stocks in the market. Now, if you own these leaders, you probably have some really good average costs and you have gains of various degrees. If you've missed one or two of these big leading stocks, you really want to keep your tabs on finding an entry in those stocks, because you want to find a way to get into the leading stocks in the market and not take tier 2 or tier 3 stocks simply because you want exposure. You're better off getting in a leader. So our goal is to focus on the leading stocks. And if we've got some cushion, we always want to consider how do we get more money into those names if we have some good cushion, and we can do it while protecting ourselves on the downside. So one of the ways to do that is to consider selling or trimming any stocks that you have small gains. And that might be stocks that are just not moving as fast as the big leaders. You have maybe gains of 5, 10, 15%, but it's not like the leaders that are up 30, 40, 50, 60, 100%. So why would we want to trim and sell those small gainers? Well, when a pullback comes back, you want to cushion yourself and your drawdown when the pullback comes. If you hold everything and they all pull in, it could be quite a bit of a drawdown, and it could really throw off your mental state of mind. So if we bank some small gains, we are going to actually be preserving mental capital because we're banking small profits. That's going to essentially cushion the blow, and it will allow us to protect our big winning stocks because we're going to hold those through the pullback if we believe we have enough cushion. This is going to give you some extra powder to add to your leaders when it's time and you find the appropriate entries. So what I'm describing to you in terms of portfolio management is something IBD refers to as the force feeding method. So let's look at this a little closer. So before we get into force feeding, I just wanted to review this slide. It was covered in last week's video or 2 weeks ago, where again, you have to decide if you have enough cushion to hold through a base. Growth stocks are going to correct more than the averages, 2 to 3 times. So if you think because you have a 40% gain in a stock and you think you're going to hold through a base that forms that's 28% deep, you're going to be brought back to break even. So be aware of that you really need possibly 50+% gains to hold through bases. So keep that in mind. So force feeding your best winning stocks. You have to determine what is the best stock that you have. And a simple way to do that is just look at the price velocity. You would have the biggest gains in that stock because it's moving up the fastest. And when it has small pullbacks, there's very little give back. And you're seeing good price action on the upside with nice volume confirming it. The technical actions telling you that you're seeing evidence of accumulation. And we've talked about blue spikes and multiple weeks in a row, gaps up, 50-day or 20-day support. So those are the stocks that may be candidates for force feeding. It also helps to have quality sponsorship increasing in your stock. So you want to look at the funds that own your stock. Are they increasing or decreasing? Is your stock having a series of positive earnings surprises? What did they do 3 months ago? Did they have an earnings surprise? We know that earnings surprises tend to occur, the odds increase each quarter when they have positive earnings surprises and positive guidance. Does your stock that you're considering the force feeding method, does it have a strong story? Are there great services and products that are driving the performance of your stock? Are you seeing earnings and sales? Is it in the theme that's being rewarded by the market? Certainly AI is one of those themes, as well as some other themes that we're seeing. And you want to be in the number 1 or number 2 leader in this particular field. So do you have the institutional quality leader, meaning it's a stock that has liquidity that allows big growth funds, institutional money, to actually own the stock? That's really important to drive the stock higher, is you need institutional backing. And again, they're looking for strong product and services. Now, I will mention, as you force feed more money into your leaders, you're going to get more concentrated. And when you put more concentrated dollars in your winners, it's going to really require conviction in that stock. You believe it can go higher because it has the products, the story, and the institutional backing. And it means you also need to do a lot of preparation. And I will say, from doing this myself, you need mental toughness. You will be tested when you create bigger positions. So let's go deeper into what we need to do to be prepared. So where are you going to find the money to force feed into your big leading stocks? So I've mentioned one technique is to sell your weakest stocks. The stocks that have the least gain, you're only up 5-10%. Taking those gains is going to give you some money to put into the leader. Also, if you're not fully exposed to the market, you should have some cash which you can deploy into leaders. But the natural question is, well, how much do I add to my big leader? Now, it's important. We always want to watch the average cost and plan. What would be the average cost if I make an additional add to a stock? You really have to be careful about getting too top heavy, because if you get too top heavy with a large position and it comes back deeper than you believe, you're going to be under a tremendous amount of pressure, and you may end up coughing up the stock or getting stopped out. Some of you are going to ask the question, well, should I be using margin to force feed my stocks? This bull market has been a slow evolving bull. I don't believe we're really in a margin type environment, in my opinion. That depends on your level of aggression. Some of you are very experienced and maybe can do that. If you're not very experienced, I would caution against using margin in this type of environment. What it really comes down to, though, is you need to know yourself. You need to know if you can handle margin, because your gains as well as your losses are magnified when you use margin. And you have to really know, can you handle swift declines or pullbacks? You must have really strong risk management controls in case the trade that you thought was going to be a big winner breaks down and sours. You need to not freeze up. So in the heat of battle, when you're on margin, are you positive that you've been through this and you have the experience that you won't freeze up? Because if you freeze up on margin, you can get really blown out. Now, if you don't have margin experience, that's fine. I would just simply don't go on margin. Just sell some of the stocks, as we mentioned, that are not big winners so far. Sell those stocks and raise some capital that you can redeploy and funnel into your winners. So let's talk a little bit about, I'll say, a guide or an example of what you might add to force feed winners. Again, every trader has to determine this themselves. You are all at different levels of aggression and experience. So this is simply a guide. So let's take position A. Let's say you have 1,000 shares and your current gain is 15%. Not a huge gain, but maybe the stock consolidates and forms 3 weeks tight, you might consider adding 10% to the position. Not too much. I certainly would not initiate a position on 3 weeks tight. That's pretty risky. Next stock, let's say you have stock DEF and you have, again, 1,000 shares. You're only up 15%. But the stock has pulled back into the 10 week or the 50-day moving average on light or normal volume. You would consider maybe add 20% to that type of position. Next example is the same 1,000 share position, but you're up more. You're up 30% on the stock. So you have some low average cost. And let's say the stock has formed a base and it breaks out of a stage 2 base. You can be a little bit more aggressive with the foundation of a stage 2 base underneath you. So I consider maybe adding 400 shares to that, which is 40% to the stock. Now, if you're fortunate to be up 55% or more with that 1,000 share position, and it's your best performing stock, let's say, and for instance, it just had some great news. Maybe it had a recent acquisition. Maybe it's bouncing off the 50-day line on big volume. Maybe it had an earnings report, which is giving it a boost higher. Maybe it's a gap up. I would see potentially adding 50% more to the position, which would be another 500 shares. Now, coming out of this situation, if you see follow through the very next day and the stock is up another 2% and big volume comes in, you might consider even adding more, another 10%, which could be another 150 shares onto the 1,500 that you own. So these are just guides to give you some context. You need to determine what your average cost is and calculate your average cost before you make the trade to make sure you can handle a pullback. So portfolio management, we could talk for an hour on that, and maybe I'll do a GMU extra on that, but portfolio management is really an art. You know, when you have larger position size, it's even more important that you consider the defense first. You have to be prepared to act if something goes wrong and you have a large position. Always watch your average cost. We've mentioned it many times. Know what quarter of the game you're in. If you believe you have a TML, a model book stock, they typically will run 18 to 21 months. So how far into the move are you? If we're only 3, 4, 5 months into that move, you're still relatively early. So it may be a good candidate to add. Keep tabs on the general market. You want to watch distribution days, stalling days. We also want to watch our breadth measures, net new highs and new lows on the index to see if they're getting into trouble. That may give you a caution sign. And always watch the action of the leading stocks. I've shown how to do that a little bit with the relative strength line and distribution days and the actual leading stocks. Hopefully, you're in the leading stocks. So to summarize this week, preparation is really important. Earnings season is here, and it's going to affect some of the moves in stocks. Now, in the last couple of days, Tesla, Netflix, and ASML in the chip sector, the earnings were not well received, and there was poor price action. So there could be potholes ahead in individual names. So you really have to consider your cushion and can you hold through earnings. My general rule of thumb is if I don't have a 10% cushion going into earnings, as a general rule, I will sell the position. But again, everyone is different, and you have to decide what's right for your risk tolerance. Now, August tends to be a seasonally slow month, slow trade. And over the last 10 years, August has generally had flat returns. It's a slow month. September is actually, in the last 10 years, has negative returns. Negative meaning, on average, minus 1.5%. It tends to be one of the worst months for the market. Now, that's one of the reasons, considering we're stretched a bit and we're going to come in a little bit, you might want to take a little bit off the table as we pull in and consolidate and cushion yourself with your positions. Again, rank your stocks best to worst and consider a plan to force feed your best stocks if you're fortunate to have what could be the market leaders. I don't see much change to exposure levels. I would not be doing a lot of buying at this stage in the market. I still think 50 to 75% exposure is reasonable. It's incremental, no plunging. I wouldn't be chasing anything extended. And I'd always, again, I keep emphasizing this, Watch your average cost. So this week, I apologize for this typo. We don't have to be smarter than the rest. We have to be more disciplined than the rest. And that's from Warren Buffett. So this week I've been pretty active. I did a Twitter Spaces a couple days ago with Jim Ropel. If you go to Stock Chart Art, you can hear the recording. It's a 1-hour Spaces. A lot of great topics were included there. And I also recorded yesterday on the Row Show a podcast. And I will tweet out the link to that podcast when it becomes available. I believe it will be on Monday. We had a really great discussion, and you may have some interest there. So that's the general market update for July 21st, 2023. I hope everybody has a great weekend. And here's where you can find me on Twitter, YouTube, and email.